Welcome back to another Market Open live stream. We are back to the day that Jerome Powell goes to talk again. Jerome Powell talks at 10 a.m. today. Obviously, every time Jerome Powell talks, the market pays attention very closely. I will be covering Jerome Powell when he talks. I'm super excited for that. It is, again, 10 a.m. I believe it was 10 a.m. Hold on a second. If it's 10 a.m., then... Now I can't remember if it's 10 a.m. their time or my time, but we're going to figure that out. I wrote it down here in one sec. But yeah, anyway, excited. We've got the market's kind of prepping based off those hawkish comments we saw yesterday. Yesterday we saw a lot of talk about, here we go. Yesterday we got a lot of commentary from a lot of folks at the Federal Reserve reiterating, it's 10 a.m. Eastern, reiterating how important it is to start tapering sooner. This is kind of the same jargon that we've been hearing. So Jerome Powell is going to be the big sort of guide on this, especially since last week, and this kind of helped lead to a rally, in my opinion. Last week, we had some folks from the Federal Reserve Board say, it's possible that we might wait on tapering. So you kind of get these crazy mixed signals from listening to the noise of all of the different board members. And this is why everybody pays so much attention to Powell, because under Powell, you have voting board members, and then you have non-voting board members, and then you have board members who sometimes vote, they rotate in and out. So you've got a whole lot of opinions below Powell, but Powell, when he talks, he tends to represent the entire the entire Federal Reserve. So that's what we're excited for today. So it is 10 a.m. Eastern time, which means basically we might just roll right into it from this, from our Market Open live stream here. But anyway, let's take a look. In the meantime, what's going on over here? Ubiquity is getting the pickup. All of a sudden, up 8.64% here in the pre-market. Big boost here. I'll go ahead and pull up the terminal to see if there's anything particular as to why, and we'll go look at some of the others here. Also, here let's get their preview here while I grab this.
Companies are trying to figure out a way to navigate through this without really restricting a lot of activity.
There was a good piece in the Wall Street Journal yesterday about supply chains and how you could track the supply issues and how difficult it is to, for example, build a spa. And a whole story about how the pieces come from so many different places and how this one spa company got destroyed, basically. Well, not destroyed, but their supply issues were so wrecked because of not just COVID, but also before that, the weather in Texas, even though they're trying to build these things in Utah. It's very interesting.
Yeah, let's talk where those guys kind of left off, which is this idea of the next steps for Fed policy. And I guess the test that you guys have put off is this test of substantial further progress on both sides of the mandate, inflation and employment. So tell me, are we there yet?
Yeah, well, Steve, thanks for pointing to the forward guidance we gave, because that's the way I look at policy and where we are. So I'm comfortable that we are basically there. I think on inflation, you can make a very good argument that we have made substantial further progress. In fact, we're well over 2% at this point. Some of that won't last, but some of it might. And we've also made a lot of very good progress on the employment side. We still see the number of jobs lower than it was in February of 2020 before the crisis hit, but we've certainly made substantial further progress since December when we put that forward guidance out. So I'm comfortable that we're basically there. And now it's a question of communicating what the policy stance is regarding our asset purchases and making sure that we do.
Loretta almost got stuck. I bet you they're all going to be talking about just one more good report, one more good jobs report, one more good inflation report.
Doing, and the whole committee has been doing, is making sure that we communicate our policy stance, where we see policy going, and our outlook.
So you're on national television with a free rein to communicate where that policy is going. Tell me about your thoughts about when this taper process ought to begin and how long it ought to go.
All right. So thanks, Steve. So, I'm comfortable if we begin to talk about, what our plans are in September, and then we start tapering sometime this year. I'd like to see those asset purchases taper down so that they're completed by the middle of next year. I think there's no urgency that we do it. I think we're in a good spot with regards to where the economy is. We can talk about Delta as being a risk to the outlook, but right now I think the asset purchases, we just don't need the same kind of accommodation that we needed at the height of the crisis, and I'm comfortable that we've met our conditions for as we articulated the forward guidance. So tapering to start sometime this year, tapering to asset purchases to end middle of next year.
Roberta, would you mind talking about the evolution of your thinking about inflation? When we spoke in June, you weren't all that concerned. You seemed to suggest that you weren't sure if this was permanent. It looked more transitory to you then. A couple months later, has your view on that changed?
Well, I think that permanent transitory probably isn't a good way to explain my views on inflation. What I'm looking at is whether some of those COVID-related increases in prices, and we've seen that in a number of places, some of the supply constraints, whether they're going to linger enough and stay on long enough that they actually get embedded into inflation expectations and then become an higher inflation on the underlying trend inflation, those core inflation measures that, if you will, that we'd like to look at to sort of give a sense of where the underlying inflation rate is going. Right now, all of the people I talk to and businesses are saying that, we thought that those supply constraints were going to ease off by now. And now it's all changed, that they see those kind of supply conditions and higher prices, their input prices lingering until next year or even later in some cases.
That's interesting.
So I think those higher prices in some of those components will stay a bit longer than we originally expected. And that could feed into inflation expectations in a way that is not consistent with our 2% mandate. So that's what I'm watching, is whether those kind of one-off price increases become embedded in people's expectations about prices continuing to rise. That's where I think we'll have to really take a hard look to see if that's happening. So far, we've seen some increases in measures of underlying inflation, but we haven't seen that be sustained. So again, I'm very watchful on the inflation side. And your original question, has my view changed? Is yes, the evidence suggests that some of those higher prices could linger for longer than expected.
That's interesting.
Do you feel like when you say you will take a hard look, do you anticipate now that inflation may need to be addressed by raising rates sooner than you expected?
Ooh.
Well, not yet. I mean, my baseline outlook is still that inflation will move back down as some of those, supply constraints ease. But I think it's up in the air now about when that timing will be. I'm concentrating now first on sort of the asset purchase part of our policy. If we complete that by the middle of next year, then we'll be able to sort of take a look at what the incoming data suggests about the strength of the economy, both on the employment side and on the inflation side. And then we'll have time to assess when that first rate increase would be appropriate. But right now, the focus in my policy is on what to do with the asset purchase program. Then we can consider raising interest rates at the appropriate time. And again, I'll point out that I'm going to be guided by the guidance we gave in our statement, that we continue to give in our statement, about what those conditions for that first rise in the interest rate would be, which is, inflation at 2% and moving above, and employment at our maximum employment mandate. So again, the forward guidance really is guiding where my policy views are.
Back in June, you gave a speech about the need to, or your suggestion that we need to incorporate financial stability into thinking about the setting of monetary.
Go get him. Go get her. Go get her.
Is in that paper. I want to ask you about the situation right now. Are you concerned that we have issues of financial stability that are made worse by what's going on with a wide open Fed of liquidity it's put out there?
Well, we have added a lot of liquidity, but some of my concerns about financial stability are longer run issues in terms of, do we have the kind of insights we'd like in the non-bank financial sector? We saw those disruptions in the treasury markets that really necessitated the Fed to move in very aggressively at the start of the pandemic because of some of the issues in the treasury market and some longer, underlying issues in sort of how the treasury market functions. So I think those are the concerns I have now. I do think that, we have frothy real estate prices. That's an area where I'm, looking at. I don't think there's a bubble necessarily, but I do think that the liquidity that our asset purchases are adding are not helping necessarily that situation, and they could be adding to further frothiness in that market. That's something I'm looking at. And leverage, especially in some of the markets, the junk bond markets, is high. And so again, not really at a point where monetary policy has to react to it, but something I'm going to be watching.
Does that, I was just going to ask, does that motivate your desire to begin this taper and remove some of the accommodation the Fed is providing, the idea that you have concerns about the frothiness in some of these markets?
Not really. It really is being driven by looking at the macroeconomy and how far we've come since we said the forward guidance in terms of substantial prices. We've made very good progress in the labor market. Some of the problems in the labor market now are supply related, not demand related. I can tell you that many across all sectors in the 4th district, which is where I'm from, all the firms are saying that it's very hard to get labor. So that's a supply side. There's some mismatching in the labor market. And on the inflation side, we're well above 2%. If you look at a backward-looking 5-year average, inflation and core inflation, PC inflation, are above 2%. So again, we've met the criteria just on the macro side for wanting to start that taper.
But we only have a few seconds left. I want to ask you very quickly. It seems like it's implicit in what you're saying that you do not have concerns that the Delta variant and the way it's spreading around the country are going to dramatically undermine either the economic progress we've seen so far or your forecast for growth in the months ahead.
Yeah, Delta is certainly a concern. It's a public health concern. And as we've seen in this whole pandemic, what happens with the economy depends on what happens with the virus. I think things are a little bit different now because we have the vaccination. And so, I'm hoping that everyone gets vaccinated because that's our best defense against Delta. The firms in my district, I've talked to them, we do a lot of outreach. There's a lot of concern about Delta. There's some tapering, maybe pushing out a little bit of some of the plans they had to bring their staff fully back into their offices, but it really hasn't changed their outlook. They're still, seeing strong demand out there. And at this point, that's my forecast as well, that nothing is smooth, everything is up and down. But we've learned to kind of navigate the virus. And I think that's really been true across businesses and households. I think we've learned. But again, the vaccination is the key here to making sure that we can maintain the progress we've made over the past several months.
Loretta Mester, thank you so much for joining us this morning. Next time, I hope we'll do it in Jackson Hole, but this was just great. Thanks very much.
Thanks, Steve.
So really interesting. So let's touch a little bit on what she had talked about. And in addition to what she talked about, I'm also going to give a little bit of perspective. Last month, at the beginning of last month, we had multiple people at the Federal Reserve say that everybody was waiting for one more good jobs report. And that jobs report is expected to come out, I believe, next Friday. Let's look at that really quick. Jobs report schedule. Let's go grab that really quick. It's usually the first Friday of every month. Okay. Yep. September 3rd. So on September 3rd, we'll get our first jobs report, or next jobs report for August. If that comes in, 900, a million jobs, we could be in a place where that taper really kicks off soon, especially if the inflation readings come in relatively stable and not falling too rapidly by the September 14th release. So those two dates, that span of 11 days, I think is going to be what determines whether we get this taper and when we get this taper and how fast it is. Now, obviously, we don't have those reports today, but Jerome Powell will be speaking in about 43 minutes. And I wouldn't be surprised if he gives us some teasers about those two reports being exactly what he's looking for. We'll see. But now, Loretta, Cleveland Fed, she says we've already arrived at where we need to be. And the reason she thinks we should taper sooner is that, and it's been a change, is that in conversation with businesses in her district, she sees supply chain issues lasting longer and being worse than expected, which that's obviously a problem because that leads prices to go up and economic growth to slow. So that'll be really interesting. I thought it was also interesting how she mentioned there's the real estate market is frothy. Not sure what would give her that opinion. Real estate's only up 20% year over year. I mean, I thought this was normal. Just kidding. And it was also good. CNBC picked up on this. They're like, wow, she didn't mention Delta at all until the end, until she was asked about Delta. And she's really brushing off Delta as, hey, we've got the vaccine, we should be okay here. But more so, she was very very focused on the supply chain issues leading to inflation rather than, what was I going to say? No, I lost. Oh, rather than Delta. Duh. I don't know why I lost that word there for a moment. But yeah, that was interesting too. So let's see here. I think Kaplan might be chatting ahead as well, but I do want to get to the sticks here in a second. I'm trying to figure out where Kaplan might be talking. All right, one sec. If he's on Bloomberg Live, we might take a peek over here in about 8 seconds. We should know because I just see a note here. Kaplan, another person from the Fed, says he thinks inflation will be in the range of 2.5% next year, but that could go up. Oh, look, found him. Can't hide from me.
Would like to see us do that process gradually over, say, 8 months. And I think we've got to get started on that. And I think to the extent we get moving on that, it may actually give us more flexibility down the road on our decisions on the Fed funds rate.
If you're just joining us, Robert Kaplan of the Dallas Fed with us on radio and television worldwide as we celebrate what we do at Bloomberg and all of Bloomberg surveillance is economics. Michael McKee leading our coverage in this hour as we go to the speech of the chairman of the Federal Reserve System, and we show you worldwide the geography of this nation from Philadelphia to Kaplan's Dallas and on to Bullard St. Louis as well. Robert Kaplan, good morning to you. I bust your chops about Dallas research because you're the only Fed president that actually reads his research. You have a spectacular research piece linking surging home prices into rent inflation. And buried in Jim Dolmas's piece is 6.9% rent increases in 2023. Is your Fed ready for that?
I think low moderate income communities are not ready for that, and they're very cognizant of having to deal with it. And I think what we're saying, part of our 2.5% plus forecast for next year is we need to anticipate this appreciation in home prices is going to translate into higher rents down the road, and that's got to be part of our thinking.
It's been highly publicized, Rob, that Fed Chair Jay Powell seems to be a little bit more dovish or a little bit more patient when it comes to the taper, when it comes to the rate hiking cycle. Where do you guys disagree most? I mean, where do you see him wrong in his thinking in terms of being patient at a time?
That is a really good question. Just nailed him.
I actually reframe what you asked slightly. I think the role of the chair is to encourage a process of debate and disagreement. This is why I thought it was so important to get asset purchases on the table. But his job is I believe the chair's job is to encourage debate and disagreement, try to forge a consensus, and understand views in order to come up with policy and have a good process. And I think Jay Powell does a superb job at that.
Okay.
Are you expecting him to make any kind of announcement today in terms of taper timing?
I would not go near commenting on what Jay Powell's going to say in his speech. I don't think it'd be appropriate.
You are tough. Kaplan doesn't expect that from you.
Well, you had to try, right?
That was brutal. Bad
I'm
form.
not going anywhere near there. Yeah.
All right. Would you expect that the Open Market Committee on September 22nd would announce a beginning of taper, or that it would come at the next couple of meetings?
Probably won't say.
So right now, I'll speak to my own process, and that may reflect on what others are doing. When I've been talking pre-resurgence, I thought we ought to be moving soon on asset purchases and beginning that process. With the resurgence, we've gone back at the Dallas Fed and redoubled our efforts over the last X number of weeks, and intensively over the last 10 days even, to look at high frequency data, real-time surveys, stepping up, talking to contacts. And what I'm seeing, and what I think we're going to see up until the meeting, but I'm going to keep reconfirming this, is resiliency. That doesn't mean that you won't see some slowing in, say, the August jobs numbers, because the matching process will slow because of fear of infection. It won't be because of lack of demand for jobs. You might see a little near-term slowing in GDP, but I don't think what we're seeing is going to change the outlook. And that's the process I'm going through leading up to the meeting. And I would guess others are doing the same process.
Robert Kaplan, thank you so much. Greatly appreciate it.
That's interesting. Christopher noticed a head nod when he was asked if the Fed is expected to raise rates. Begin the taper on the 22nd. That's interesting. Now, we just got our time frame too, which is really cool, because I heard your name mentioned as running for gov on the radio while in Tallahassee over the weekend. That's awesome, Tallahassee. That's interesting. Okay, so this is interesting. I keep saying things are interesting. It is all interesting. But anyway, the jobs report comes out on the 3rd. So I'm gonna write this down. I would encourage you to write this stuff down too. Like especially if you're a trader, because these are moments, catalysts. So on the 3rd, we get jobs. On the 14th, we get CPI. And you better have cast your ballot if you're in California, because if you ain't voting, you're losing money for your district. Doesn't even matter if you think your vote matters. Just get it in for the money that your district gets. Then on the 22nd, the Fed decides, so I'm going to put FOMC, whether or not to announce that taper. I don't know. That's 50-50. It's going to come down to that jobs report. Excuse me. If that jobs report is over 900K jobs, and if CPI is still over 5% year over year, it could be interesting. You could see the start to that taper. That's yeah, I like it. I like our analysis, not necessarily that there will be the taper, but I think we did good work here. So I am absolutely blown away. Peloton is only down 4.6% right now. I am blown away. That's shocking. Very, very shocking after what we saw yesterday. So yeah. Then we've got Alibaba down 3% again. Geez, Playboy, Tattooed Chefs, so some of the SPACs have a little weight. Market's not down horribly here. Not bad at all in terms of, given the fact that we are right against the Jerome Powell talk. So what else? Let's see here. We've got on the upside, we got 3 minutes to the bell. Ubiquity, Dave & Buster. Dave & Buster doing good again. Yeah, yesterday, the last 2 days it was down. The days before that it was green. So you get a lot of this volatility here in recovery stocks. Market's kind of boring right now. Not a lot. I mean, Tesla 0.7, that's nice. No major movers. I have not seen the momentum movers yet. Crypto is still bobbing around that 47 for Bitcoin. Let's take a look at some headlines here. So Wall Street Journal, big old news here on Kabul. Evacuations resume. 13 troops killed, so one addition from yesterday. I did yesterday say Navy medic. Apparently it was a corpsman. But anyway, in terms of the person from the Navy who died. Biden vows retribution. We will hunt you down. Oh, and hey, look, there's Kevin. Yeah, they did an article. Look at that. The social media stars who move markets. That's my set. That's pretty cool. U.S. consumer spending grew. Oh, I want to look at this though. Spending was up 0.3%, and personal income rose 1.1% as the Delta variant and other factors limit companies' ability. Ooh, I'm going to take a look at this. Quick note before the opening bell. Public has partnered with me to give you one free stock. Go to metkevin.com/public, and they'll give you one free stock worth all the way up to $70. Metkevin.com/public. They don't sell your data. And yeah, you can follow me at MeetKevin on there as well. And of course, the Jack's birthday coupon for the programs down below, 40% off on building your wealth, expires on the 31st. That is Jack's birthday. He's turning 6. And I do expect to make some more trades today because I want to prep going into next week, especially after Jack's hole here. So I'm excited. And then, of course, every time I make a transaction, I send that over to you with Stocks and Psychology Money. But anyway, let's take a look at this here. Consumer spending income grew in July. Spending was up 0.3% and personal income rose 1.1% as the Delta variant, other factors, limit ability of companies to serve. U.S. household incomes rose by a robust 1.1%. That's interesting. More cash for people again. U.S. household income rose by 1.1%, but spending slowed at 0.3%. I wonder if any of this has to do with that child tax credit too. And to me, this definition right here is very frugal decade-ish. I was literally just going to talk about Peloton too. This is interesting.
Not necessarily the problem.
Meanwhile, where is the multiple, Mike? I mean, what are we talking about here?
I mean, they're not really on a bottom line basis going to make too much money.
Right.
I looked at one report that says, 15 times, kind of a blended for the sum of the parts. But it's mostly on like kind of gross profit or revenue in 2023. So you have to be creative in terms of how you value it. I think it's honestly, it's just kind of like this brand that it's a bet on the staying power of the brand and the fact that they're going to own this area for a while. And it's interesting, Affirm often linked to it, not necessarily looking like it's going to be hurt too bad, at least this morning on the news yesterday. Yeah, they finance a lot of money.
Huge part of Affirm's revenue base for sure is Peloton. Let's get to the opening bell on this Friday morning. The CNBC real-time exchange with a big board. It's UK-based used car seller Kazoo celebrating its listing on the NYSE. As an Nasdaq, it is robotic.
Just what we need is another car seller. Not.
Other big mover this morning has been Gap.
Oh, look how green it is.
Beats 46. Revenue ahead. Comps up 3, up 12 on a 2-year stack. Athleta up 13 and Banana up 41, which got some people's attention. They do raise the guide. See full year revenue in the low 30s, prior 21 to 25. Retail all week long, guys.
Yeah, it's been mixed. Of course, we know what happened with Nordstrom. That stock down sharply. Williams-Sonoma, Best Buy quite positive. Dick's Sporting Goods quite positive, and Gap moving higher. Although again, it's interesting. Having done the closing bell yesterday, Mike, I know how all these stocks were moving after hours. Gap was up more than it actually has opened up, and as you pointed out, Peloton is down less than it looked like, at least aftermarket. But they're comparing to 2019 numbers as well, and clearly Athleta and Old Navy are the star performers. But the declines at Gap have lessened as well. Still declining. I think it was about 10% versus 19, if I recall, but a lesser decline overall. And I think 33% of overall revenues came from online, which was down from 40% in the last quarter.
Yeah, there's, I guess, just a sense that the ongoing store closures for various concepts have gotten to a point, and the online sales reached a threshold where it's definitely still relevant. And Athleta, for years people were like, wow, people love Lulu. What about Athleta? It was just too small necessarily to be reflected in the valuation. So it's where, but tremendous separation in retail, right? I mean, the dollar stores getting pounded.
Right.
Anybody that can't pass along any prices, if you're in apparel and home goods or sporting goods, it seems like things are okay.
Yeah, it's interesting.
That's interesting. I always say everything's interesting. But yeah, I mean, we saw that with Dick's. I mean, this explosion here in Dick's is really incredible. And I mean, they've had an incredible year, and then they just recently exploded. It's not too unfamiliar. And this is Dick's Sporting Goods too, which I suppose really makes sense with reopening as well as stay at home, right? It's just both reasons, but very, very similar here to Macy's. Just basically retail having done much better than expected. Although Nordstrom's recently got shafted. See, they had the opposite of Dick's. Dick's was sort of straight up and then up even more. Nordstrom doesn't have that luxury. I'm also surprised Etsy right now is at 210. Good for them. Let's see here. Ubiquity is one that I've really been watching. They just had an excellent report. In fact, I did pull up their earnings. Let me just see really quick how much they got. They pumped by. So Ubiquity EPS came in at 247 versus 241 expected. By the way, I did just put in a tiny little sell on M1 Finance. So if you're part of Stock Psychology Money, you could see that. Okay, so Ubiquity, 247. Yeah, okay. Sales came in at 477 mil versus 463 expected. That's pretty good. I love the Ubiquity products. They're a little bit more advanced, which sometimes makes me a little bit frustrated with them. But I know they're very, very capable. It's a great system. But this is why I've been watching Ubiquity so much. I've just been too much of a baby to finally start a position in them. Cardano back to 273, up from its 253 area here. Dave & Buster's. Dave & Buster's is really what's moving today. Just the volatility, though, here has been absolutely incredible. Now, $38.50 does put it around its February pricing. I'm going to go ahead and pull up earnings on this one really quick. Let's see here. Let's see. Okay, let's go into Dave & Buster's and let's just take a peek at their valuation and when we think they'll be profitable again. So thank you, Ross, for this very nice comment for our heroes. Okay, let's go to financial analysis. Okay, we're on behalf of our heroes. All right, so looking at Dave & Buster's, well, we're expected to be negative EPS this year, but expecting really growth to come back with positive earnings in 2022. Oh, but this is their year ends January 31st, 2022. Oh, that I hate it when they do that. It's so confusing when they have their year ends. So bizarre. Because that's basically most of 2021 is what they're saying here. That is confusing. Okay, so we only go out to 2023 and then no, here we go, 24. Okay, 24.5. Okay, perfect. So here, Dave & Buster's is still. That's interesting. So massive growth here, 2021 on the reopening. This makes sense. Then to about 18% growth most of 2022. But then seeing growth slow to 4% and 2% in 2024 and 25. I don't know. I still think they can crush it if they really get the small stores moving. Oh, Bullard must be on Bloomberg talking about how asset purchases don't have much value right now. But anyway, we expect within the next year them to get back to $2 of earnings per share, which really prices them around, 18 times earnings right now. It's not horrible, and kind of makes me curious. Let's see here. Yeah, I mean, I don't know. Let's look at Delta cases again. Oh yeah, here's Bullard. I'll listen to Bullard while I pull up Delta cases.
you could have to raise rates because inflation is higher than you anticipated, but you don't get the unemployment rate down as far as you would like to, or at least in terms of the diverse and inclusive unemployment rates?
Now we'd be hitting the new framework exactly. Yeah.
Pretty consistent with last week, by the way, on COVID cases, so relatively flat. Bullard, and then I'll pull up AMC while he's talking.
Had inflation above the 2% target for some time, and then inflation on a core PCE basis would be averaging 2% over some kind of 5-year window, nice. Either backward-looking or centered and forward-looking. And so you'd be hitting it on that dimension. And then I think on the jobs, you've got to think about.
Look at this bounce off our line on AMC. This line has been here forever, and this is a near perfect bounce.
And it certainly looks like you're going to have a very strong jobs market at that point. I mean, you can make the argument today that this is one of the tightest job markets we've seen in recent decades, because the unemployment to vacancies ratio has gone down below 1, so more than one job opening for every unemployed worker. If you want a broad measure of labor market performance, you can look at the Kansas City Fed's labor market conditions index. That's moved up into positive territory and is headed toward very high numbers, which will be, again, indicating one of the strongest job markets that we've seen in recent decades. So
it just doesn't work that way.
What you're hearing on this show and everywhere across the economy about jobs, which is that firms are having a really tough time hiring. They're offering wage increases, they're offering bonuses, they're offering signing bonuses, retention bonuses. They have job fairs where no one shows up. So lots of things seem to be pointing.
Whoa, job fairs where no one shows up?
You're going to have 6% growth in the U.S. economy over the second half of this.
I don't even know what to make of that. That blows my mind.
It's going to improve all that much more. So I think we'll be in great shape in the first half of 2022, but we have to have some optionality there in case inflation doesn't moderate.
Well, what are companies telling you about what they're having to pay and how long they think they're going to have to pay it, both for input goods and for labor? Is this going to be something that at this point they're anticipating a bit of a cycle?
Well, one of my top concerns, and I've heard it on listening to you guys, is CEOs will come in and they'll say, yeah, my input costs are way up, but we don't think this is a problem. We're going to pass that right on and raise prices. And, my labor costs are up, but we're going to pass that on into prices. That sounds like a worrisome dynamic to me, and one that, we certainly want real wages to go up, but for everyone, we want those to be as high as possible. But we don't want to get into a cycle where that just feeds through to the inflation process in the economy.
Jim Bullard, Tom Keenan, good morning to you. Thrilled to speak to you before Chairman Powell. Jim Bullard, I want to go back 5 years to two big things of 2016. One of them was Marvin Goodfriend and the uproar over his paper at Jackson Hole, the late Marvin Goodfriend, folks of Carnegie Mellon, on zero interest and the negative rates. Well, guess what, Jim Bullard? Goodfriend was right. Negative rates up worldwide as well. And also, you may recall in 2016, somebody in St. Louis said, forget about a single point outcome. We are
support.com is like totally meme squeezing, by the way. Most of it in the pre-market here. So we'll look at that in a moment. It's suspended now.
Can we get to a constructive, different state given the huge negative interest rates worldwide?
Good point.
Yeah, I think after Professor Goodfriend's paper, central banks around the world did experiment with negative rates, I think with very mixed success. And I think that's why we've tried to avoid that outcome in the U.S. With respect to the regime, I mean, I did switch in 2016 to saying that I thought we were just in a low inflation, low nominal interest rate, low real interest rate environment, slow growth, and that wasn't going to change very readily, and that meant that monetary policy didn't have to be as aggressive as we had previously been. So I was kind of on the dovish side at that point. But now we're coming through this pandemic, and policy-wise, it's been a human tragedy, of course, of unimaginable dimensions. But from the economy's point of view, we played it very well as a nation with the fiscal policy and the monetary policy. And now we're coming out of the pandemic with a very strong economy. And I think it's very possible that we're switching into a high productivity growth regime. And that means somewhat higher interest rates than you'd otherwise have seen. It means faster growth than you otherwise would have seen. Wow. And I'm hopeful that all of that occurs. The last time we had a faster growth, higher productivity growth economy was the late 1990s, where we boomed for 4 years and started talking about paying off the entire national debt.
Well, and Jim, you're talking about negative.
That didn't happen.
Yeah, that didn't happen. No.
Happened in the end.
But Jim, you're talking about negative interest rates and how that's been problematic in certain ways, and certainly in the United States, it wouldn't be as smooth as it has been in other places for the money market fund and a variety of other reasons. But you've talked about the need to get interest rates up so that we can use that and combat the next downturn, have some ammunition. If we cannot get rates substantially higher, how do you foresee asset purchases?
That's a big shift, by the way. Just saying, like, that's a huge shift.
They've become a standard part of the toolkit, and we used it after the global financial crisis, pioneered by former Chairman Bernanke, and kudos to him for that. And then, when this crisis came along, we went right back to it with considerable success, I would say, in the March, April 2020 period, where we really were staring at a possible depression and a possible financial crisis. And I thought Chair Powell did an excellent job during that time frame in getting us into a policy that avoided the financial crisis that could have occurred on top of the pandemic, and put us on very good footing. It wasn't too long after March, April that financial stress measures came way down from very high levels, and we got back to normality, at least with respect to financial markets. So asset purchases are part of the toolkit, and they're here to stay. But right now, I don't think they're helping us that much, and they may be causing harm, especially in housing, where we don't want to feed into an incipient housing bubble. We got into a lot of trouble in the mid 2000s with housing, and I'm not too anxious to try to see that happen again. So I think that just the time has come to end these purchases, and
the time has come. The moment is at hand.
We may have to do in 2022, but we're not. We're certainly going to keep sharp control over our interest rate decisions. We're not going to be on any kind of mechanical path, but we're going to want to assess where we are in the spring of 2022 to see what course we want to chart.
Peloton slipping it. I knew it. When I saw it was only down 4%, I'm like, I don't know. That was not a good report. Very bad. And it actually reiterated some of the indicators that I've been seeing starting about 3 weeks ago, which is why I dumped all of my options on Peloton and including some of my shares. So that's odd. Anyway.
We're not going to have an inflation problem. If you send a message that maybe we will, and it's time to stop giving you guys support, we're going to have a problem?
I don't think so. I mean, you talk to pretty much everybody in the markets, and my sense is that, at some level, the tapering process has already been priced in. Yeah. Maybe not all the details around it or exactly how it will unfold, and so there's a little bit more there, but certainly seems like commentators and traders are well aware that there will be a tapering process, and that it makes sense at this point, given how well the economy has done. This economy is producing more national income than the one that existed before the pandemic. The pre-pandemic economy didn't have zero interest rates, by the way. So I think I think markets would react, in some broad sense, they'd react well to this because it would mean that the Fed is going to stay in good position to handle all the possibilities that might come. If inflation moderates in 2022, we're in great position for that. And if we get the taper out of the way, then we'll also be in good position in 2022 if we have to tamp down a little bit on inflation pressure in the economy.
Dr. Bullard, thank you so much for joining us today from St. Louis. Jim Bullard as well. Michael McKee, this has been
Yeah, I'm going to pull up the short interest on support. I personally don't believe what we're seeing at support is a short squeeze, but I have not looked at the short data, so I could be wrong. Okay, let me see here. Could be very wrong. Do want to see if I can do no. Okay, extra. I don't know if this is gonna work. Oh, I do want to try this really quick. So let's see. Mute. Stop. Okay, perfect. Share. If I could share this one more screen, I don't know if that would be weird or if this would work. Because sometimes we can keep looking at the sticks while we let's see here. Share screen window. No, I don't think it's gonna let me do that. Chrome tab. No, never mind. That doesn't matter so much. Okay, no worries. So I can play around with that later. Let's look at that short interest on support. So support, I mean, and again, it is pretty high. It's showing at 59.7%. So maybe I'm wrong about that. Yeah, look at that. 59%. And the short interest really exploded only about 2 weeks ago. So that's one of the highest short interests that I've seen in a while. Now, the reason I was initially skeptical about whether or not this was a short squeeze on support, where's the darn thing? Suspended again? Yeah, it is. The reason I was initially skeptical is because most of the run-up occurred in the pre-market. I personally get nervous when I see pre-market runs because I think they're unsustainable. Let me see. Support.com stock. It is, especially if it's a low oh gosh, yeah. Come on. It's an $888 billion market cap at 35% up. I'm sorry, at 85% up. So this was really like a $500 million market cap stock. $500 million market cap with a like 57% short interest, and then people pumping it in the pre-market. Like it's only a $500 million market cap getting pumped in the pre-market, and it shows that kind of short interest percentage. My gosh, that is like the perfect recipe for skyrocketing, which in my opinion is why now that we're in the open sort of free market here, you're going to see a ton of profit taking. I personally don't believe that this could sustain a pre-market pump like this. I don't know that, like, and I'm not trying to like downplay it or discourage it. I would just be very nervous about this. Now, if we had this run during the day, I would agree more that this is short interest, maybe a short squeeze. This right here to me is just people going momentum, moving a $500 million stock, which surprisingly, not that hard to do. Certainly not that hard to do pre-market, because pre-market, you're just milking that order book, and you're hitting new pre-market sellers, which is very, very few, and you're just going ding, 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 ding. You're moving up that order book, just trying to get shares, and that does not last, in my opinion. Again, could be wrong. It's going up right now, so obviously it still has momentum, and it's an $886 million stock right now. So who knows? Maybe it'll keep running. It's certainly not plummeting at the very moment after reopening here. But this is interesting to me. This is definitely getting every trader's attention right now. So very interesting. But hey, look, if you can make money trading it, if this ends up shooting up another 20, 30, 40, 50%, 100% or whatever, make your money, get out. I wouldn't want to hold this thing until tomorrow. That would be my thought. So up 112% now. It's definitely moving. You got people opening positions on it. But yeah, the shelf under this one is not going to be very strong. So we'll keep an eye on that. I think that's fun. Heck, I might even throw on in terms of a trade, but probably not right now. But let's see. If I were to throw in an active trade, I don't know. What would we do? And I'm not going to right now, but I don't know. Maybe like 20, 25. Okay, there we go. And it would just be totally for giggles. But again, I'm not going to do it right now, especially since right now we are downtrending on the minute. So, but yeah, I mean, this is the perfect recipe for a social media encouraged or induced squeeze. And I borderline don't even want to call this a squeeze. It's more of a social media induced rush, because short sellers don't immediately get screwed here. Just my take. So let's see, what else? What else? Root, in the insurance company's moving here. I'm going to look at this 9.88%. I'm going to look at this a little more broadly here. Golly, yeah, they've just gone to the toilet. They were, I want to say they were a SPAC too. Root Insurance, was it a SPAC? Let's see here. Root Insurance is a company that uses AI to figure out driving habits. Or did they IPO? Insurtech to go public, including Root. No, it was a SPAC. Yeah, February 11th. Is that right? No, that's not right. Root stock down from Q and that's it. Okay. Root stock. Let's see here. Okay, blah 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 blah. Root company. It just says since IPO. I don't know if it's SPAC'd. I do want to know if it did. Oh, here we go. No, that's a different one. Closest listed peer. Oh no. Maybe they didn't SPAC. Maybe they regular IPO'd. That's interesting. Yeah, because this is if this is a SPAC, this pattern makes more sense. If it's not, it makes less sense. Root Insurance. Let's see if there's mention of the IPO. Should be easier to figure this out. IPO. No, it had its IPO. It had an IPO. No SPAC. Wow, they IPO'd at $27. That's incredible. I'm gonna look at the fundies of Root. Actually, we could together look at some of the trends on this one. All right. So let's start here. Is it just Root.com or is it Root Insurance? Root Advisors. Okay, so not that one. Root Insurance. Join Root. Why does it sound like Groot? Join Root. They've been pretty stable with their website rank. How's their traffic been? They've had greater time on website by 15% bounce. I mean, this is not bad. Let me do a trend search. Root Insurance. Root Insurance been stable over 12 months, so it doesn't have the growth that we see at like Lemonade. That's not. Let's see. I'm going to compare to Geico for a moment since they are car insurance. I mean, that's not even comparable. Lemonade Insurance. Oh, that's not bad. Similar trajectory here. And it's also interesting because Lemonade does not yet do car insurance. That is very cool. Yeah, see, Root just does car insurance right now. Very and Lemonade's doing like pet insurance and stuff. So that is very interesting. This to me is bullish for Lemonade, because if Lemonade is right here, sorry, I know I'm in the way. If Lemonade is right here with Root, and Lemonade doesn't yet have car insurance, but they're planning on releasing car insurance soon. Woo! That's interesting. Okay, let me look at the fundies really quick on Root, and then we'll jump on over to JPow. All right, let's see. Plate 13 reported 200. You got to be careful. It's such a small company that I don't know that that's, looking back into the middle of last year, I don't know that you want to use that percentage. I'll look at that in just a moment. But I think that's a little misleading. I'm skeptical. Every time I hear something, I'm almost skeptical to start with. Okay, Root Insurance, like Lemonade, not expected to be profitable anytime soon. Root Insurance right now only has a market cap. Is that right? No, that's older. Root Insurance, the market cap should be lower than that. Oh yeah, no, okay, it's 1.65 billion right now. Yeah, I guess that's not that bad. Expected really to be a money loser until I don't actually have it ever going profitable. Oh god. And the growth projected for Root is just not that good. So I don't know if Wall Street is just not happy with Root or what, but the growth projections for Root are not phenomenal. Yeah. All right, let's look together. I'll pull up here the Planet 13 Investor Relations. I get very skeptical when people talk about these big percent gain numbers, because I think they're very misleading, especially if we're comparing to last year. This is the Canadian pricing. Okay, where are we? Let's see. Is this what just came out? June 30th? Yeah, should be. All right. So, okay, cash. That's very good. From the end of the year. A lot more cash. Did they raise money? Liabilities. Oh, hell yeah, they did. Oh my gosh, their liabilities went up $14 million versus, but they got 130. Wait a minute, wait a minute. That's not that much more of liabilities. 14 mil. Gosh, they got a lot of cash all of a sudden. That's actually good. That's a really nice boost in cash. 136 million versus 79. That's good. That's a good thing. I like seeing that. And it's actually not all from debt. Very little of it appears to be from debt. Share capital. This one. Okay, this is what. So they sold issued shares. That's where the money came from. Okay. So revenues ended. 3 months ended June 30th. Where? June 30th, 2020. 6 months ended. 6 months ended. 3 months ended. Yeah. See here, this is what this 3 months ended June 30th, 2020. Come on, man. That's like April, May, and June during the pandemic. We can't compare to that. This is a better comparison, the 6 months, but this still represents a lot of pandemic crush, right? Yeah, but that's a rough comparison. Let's see how their margins are doing. We got 30 seconds and we're going to run. Administration up. Oh my gosh, their sales and marketing expenses exploded. What's the breaking news here?
Santoli and David Faber live in Post 9 of the New York Stock Exchange. Morgan Brennan has the morning off. Dow hanging on to a gain.
Okay, there's really no breaking news there. Okay. I would love to know, let's see, their profitability, but we only have another 20 seconds here. So comprehensive income, net income or loss. They got better by about 400K, which is good. Yeah, and I want to know their gross profit. 18 out of 36. Similar. 18.3. 18.3 divided by 32.8. Gross profit's about 55.7. 4.73 divided by 10.76. 44. Yeah, it's improving. That's good. That's good. They are getting better.
For inflation. On the employment mandate, he says there's clear progress towards maximum employment, but importantly,
let's go listen to Powell.
Does not say that substantial further progress that test has been met. He does say the Fed has made progress, or the economy has made progress on the goals for reducing asset purchases this year, but again, doesn't say that those goals.
This must be a statement.
He points out the Delta variant presents a near-term risk. It seems to clearly be attenuating his sense of when the taper should begin. The outlook for on the employment mandate, he says the outlook for the labor market has brightened considerably, but it is turbulent, and employment gains have come faster than expected. So he does seem to be optimistic about the ability to meet that goal relatively soon. On inflation, he says inflation at current levels is, quote, a cause for concern. High inflation readings, however, he says, will likely prove to be temporary. He says it results from a narrow group of goods and services and does not see wage push inflation. In fact, Powell points out he already sees some moderation in prices. However, he would be concerned if inflationary pressures spread more broadly to the economy. And he points out global disinflationary forces still remain. On the issue of rate hikes, he's very clear in saying the timing of asset reductions or a taper is not a direct signal to the timing of rate hikes. Again, he's trying to separate those two actions by the Federal Reserve. He says there's a different, more stringent test for rate hikes. Tightening too early, he says, could be particularly harmful, and the central bank cannot count on inflation being transitory. Carl, back to you.
Steve, thank you. Let's get to the Fed chair.
This shock led to an immediate and unprecedented decline as large parts of the economy were shuttered to contain the spread of the decline.
So that was his opening sort of probably press release statement. Now he's recapping the start of the pandemic, and now we can listen to his new stuff.
Thanking those on the front line fighting the pandemic, the essential workers who kept the economy going, those who have cared for others in need, and those in medical research, business, and government who came together to discover, produce, and widely distribute effective vaccines in record time. We should also keep in our thoughts those who have lost their lives from COVID, as well as their loved ones. Strong policy support has fueled a vigorous but uneven recovery, one that is, in many respects, historically anomalous. In a reversal of typical patterns in a downturn, aggregate personal income rose rather than fell, and households massively shifted their spending from services to manufactured goods. Booming demand for goods and the strength and speed of the reopening have led to shortages and bottlenecks, leaving the COVID-constrained supply side unable to keep up. The result has been elevated inflation in durable goods, a sector that has experienced an annual inflation rate well below zero over the past quarter century. Labor market conditions are improving but turbulent, and the pandemic continues to threaten not only health and life, but also economic activity. Many other advanced economies are experiencing similarly unusual conditions. In my comments today, I will focus on the Fed's efforts to promote our maximum employment and price stability goals amid this upheaval, and suggest how lessons from history and a careful focus on incoming data and the evolving risks offer useful guidance for today's unique monetary policy challenges. The pandemic recession, the briefest yet deepest on record, displaced roughly 30 million workers in the space of 2 months. The decline in output in the second quarter of 2020 was twice the full decline during the Great Recession. But the pace of the recovery has exceeded expectations, with output surpassing its previous peak after only 4 quarters, less than half the time required following the Great Recession. As is typically the case, the recovery in employment has lagged that in output. Nonetheless, employment gains have also come faster than expected. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. The unevenness of the recovery can further be seen through the lens of the sectoral shift of spending into goods, particularly durable goods such as appliances, furniture, and cars, and away from services, particularly in-person services in areas such as travel and leisure. As the pandemic struck, restaurant meals fell 45%, air travel 95%, and dentist visits 65%. Even today, with overall GDP and consumption spending more than fully recovered, services spending remains about 7% below trend. Total employment is now 6 million below its February 2020 level, and 5 million of that shortfall is in the still depressed service sector. In contrast, spending on durable goods has boomed since the start of the recovery and is now running about 20% above the pre-pandemic level. With demand outstripping pandemic-afflicted supply, rising durables prices are a principal factor lifting inflation well above our 2% objective. Given the ongoing upheaval in the economy, some strains and surprises are inevitable. The job of monetary policy is to promote maximum employment and price stability as the economy works through this challenging period. I'll turn now to a discussion of progress toward those goals. The outlook for the labor market has brightened considerably in recent months. After faltering last winter, job gains have risen steadily over the course of this year and now average 832,000 over the past 3 months, of which almost 800,000 have been in services. The pace of total hiring is faster than at any time in the recorded data before the pandemic. The levels of job openings and quits are at record highs, and employers report that they cannot fill jobs fast enough to meet returning demand. These favorable conditions for job seekers should help the economy cover the considerable remaining ground to reach maximum employment. The unemployment rate has declined to 5.4%, a post-pandemic low, but is still much too high, and the reported rate understates the amount of labor market slack. Long-term unemployment remains elevated, and the recovery in labor force participation has lagged well behind the rest of the labor market, as it has in past recoveries. With vaccinations rising, schools reopening, and enhanced unemployment benefits ending, some factors that may be holding back job seekers are likely fading. While the Delta variant presents a near-term risk, the prospects are good for continued progress toward maximum employment. The rapid reopening of the economy has brought a sharp run-up in inflation. Over the 12 months through July, measures of headline and core PCE inflation have run at 4.2% and 3.6% respectively, well above our 2% longer run objective. Businesses and consumers widely report upward pressure on prices and wages. Inflation at these levels is, of course, a cause for concern. But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. This assessment is a critical and ongoing one, and we are carefully monitoring incoming data. The dynamics of inflation are complex, and we assess the inflation outlook from a number of different perspectives, as I will now discuss. The spike in inflation is so far largely the product of a relatively narrow group of goods and services that have been directly affected by the pandemic and the reopening of the economy. The durable goods alone contributed about 1% to the latest 12-month measures of headline and core inflation. Energy prices, which rebounded with the strong recovery, added another 0.8% to headline inflation. And from long experience, we expect the inflation effects of these increases to be transitory. In addition, some prices, for example, for hotel rooms and airplane tickets, declined sharply during the recession and have now moved back up close to pre-pandemic levels. The 12-month window we use in computing inflation now captures the rebound in prices, but not the initial decline, temporarily elevating reported inflation. These effects, which are adding a few tenths to
Here's how the market responded so far, by the way.
Out over time. We consult a range of measures meant to capture whether price increases for particular items are spilling over into broad-based inflation. These include trimmed mean measures and measures excluding durables and computed from just before the pandemic. These measures generally show inflation at or close to our 2% longer run objective. We would be concerned at signs that inflationary pressures were spreading more broadly through the economy. We are also directly monitoring the prices of particular goods and services most affected by the pandemic and the reopening. and are beginning to see a moderation in some cases as shortages ease. Used car prices, for example, appear to have stabilized. Indeed, some price indicators are beginning to fall. If that continues, as many analysts predict, then used car prices will soon be pulling measured inflation down, as they did for much of the past decade.
Yep.
This same dynamic of upward inflation pressure dissipating and in some cases reversing seems likely to play out in durables more generally. Over the 25 years preceding the pandemic, durables prices actually declined, with inflation averaging negative 1.9% per year. As supply problems have begun to resolve, inflation in durable goods other than autos has now slowed and may be starting to fall. It seems unlikely that durables inflation will continue to contribute importantly over time to overall inflation. We will be looking for evidence that supports or undercuts that expectation. We also assess whether wage increases are consistent with our 2% inflation goal over time. Wage increases are essential to support a rising standard of living and are generally, of course, a welcome development. But if wage increases were to move materially and persistently above the levels of productivity gains and inflation, businesses would likely pass those increases on to customers, a process that could become the sort of wage price spiral seen at times in the past. Today, we see little evidence of wage increases that might threaten excessive inflation. Broad-based measures of wages that adjust for compositional changes in the labor force, such as the Employment Cost Index and the Atlanta Wage Growth Tracker, show wages moving up at a pace that appears consistent with our longer-term inflation objective. We'll continue to monitor this carefully. Policymakers and analysts generally believe that as long as longer-term inflation expectations remain anchored, policy can and should look through temporary swings in inflation. Our monetary policy framework emphasizes that anchoring longer-term expectations at 2% is important for both maximum employment and price stability. We carefully monitor a wide range of indicators of longer-term inflation expectations. These measures today are at levels broadly consistent with our 2% objective. Because measures of inflation expectations are individually noisy, we also focus on common patterns across the measures. One approach to summarizing these patterns is the board staff's Index of Common Inflation Expectations, which combines information from a broad range of survey and market-based measures. This index captures a general move down in expectations starting around 2014, a time when inflation was running persistently below 2%. More recently, the index shows a welcome reversal of that decline and is now at levels more consistent with our 2% objective. Longer-term inflation expectations have moved much less than actual inflation or near-term expectations, suggesting that households, businesses, and market participants also believe that current high inflation readings are likely to prove transitory, and that in any case, the Fed will keep inflation close to our 2% objective over time. Finally, it is worth noting that since the 1990s, inflation in many advanced economies has run somewhat below 2%, even in good times. The pattern of low inflation likely reflects sustained disinflationary forces, including technology, globalization, and perhaps demographic factors, as well as a stronger and more successful commitment by central banks to maintain price stability. In the United States, unemployment ran below 4% for about 2 years before the pandemic, while inflation ran at or below 2%. Wages did move up across the income spectrum, a welcome development, but not by enough to lift price inflation consistently to 2%. While the underlying global disinflationary factors are likely to evolve over time, there is little reason to think that they have suddenly reversed or abated. It seems more likely that they will continue to weigh on inflation as the pandemic passes into history. We will continue to monitor incoming inflation data against each of these assessments. To sum up, the baseline outlook is for continued progress toward maximum employment, with inflation returning to levels consistent with our goal of
The market's loving this.
% over time. Let me now turn to how the baseline outlook and the associated risks and uncertainties figure in our monetary policy making. The period from 1950 through the early 1980s provides two important lessons for managing the risks and uncertainties we face today. The early days of stabilization policy in the 1950s taught monetary policymakers not to attempt to offset what are likely to be temporary fluctuations in inflation. Indeed, responding may do more harm than good, particularly in an era where policy rates are much closer to the effective lower bound, even in good times. The main influence of monetary policy on inflation can come after a lag of a year or more. If a central bank tightens policy in response to factors that turn out to be temporary, the main policy effects are likely to arrive after the need has passed. The ill-timed policy move unnecessarily slows hiring and other economic activity and pushes inflation lower than desired. Today, with substantial slack remaining in the labor market and the pandemic continuing, such a mistake could be particularly harmful. We know that extended periods of unemployment can mean lasting harm to workers and to the productive capacity of the economy. History also teaches, however, that central banks cannot take for granted that inflation due to transitory factors will fade. The 1970s saw two periods in which there were large increases in energy and food prices, raising headline inflation for a time. But when the direct effects on headline inflation eased, core inflation continued to run persistently higher than before. One likely contributing factor was that the public had come to generally expect higher inflation. One reason why we now monitor inflation expectations so carefully. Central banks have always faced the problem of distinguishing transitory inflation spikes from more troublesome developments, and it is sometimes difficult to do so with confidence in real time. At such times, there is no substitute for a careful focus on incoming data and evolving risks. If sustained higher inflation were to become a serious concern, the FOMC would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. Incoming data should provide more evidence that some of the supply-demand imbalances are improving, and more evidence of a continued moderation in inflation, particularly in goods and service prices that have been most affected by the pandemic. We also expect to see continued strong job creation, and we'll be learning more about the Delta variant's effects. For now, I believe that policy is well positioned. As always, we are prepared to adjust policy as appropriate to achieve our goals. That brings me to a concluding word on the path ahead for monetary policy. The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis. These are challenging times for the public we serve, as the pandemic and its unprecedented toll on health and economic activity linger. But I will end on a positive note. Before the pandemic, we all saw the extraordinary benefits that a strong labor market can deliver to our society. Despite today's challenges, the economy is on a path to just such a labor market, with high levels of employment and participation, broadly shared wage gains, and inflation running close to our price stability goal. Thank you very much.
See if he does questions. I don't think he will.
That is Fed Chair Powell speaking at the Jackson Hole.
All right, let's go ahead and do a summary here of what Jerome Powell just said. So I'll give you a summary. And yeah, this is actually way better than expected. The market's loving this, loving this, loving this, loving this. Okay. So give a quick summary here. As usual, this video is sponsored by the link down below to get a free stock with Public up to $70. Go to makekevin.com/public. And my programs on building your wealth. You can get 40% off using that coupon code and all my buy, sell alerts and stocks and psychology of money. That expires on August 31st. Let's just talk about what Jerome Powell just said, though. So first, Jerome Powell's opening statement that was released before he started talking gave the market enough relief to lead the S&P to bounce up decently. We saw the markets immediately move up. And this is mostly because Jerome Powell started in his statement much more dovish than expected. Over the past few days, we've had some negativity in the market because some other board members have been coming out pretty hawkish, especially non-voting board members. Even this morning, we've had other people going, I don't know, like Loretta Mester, just about an hour ago. Loretta Mester was saying, I am hearing businesses say hold on. Sorry, I had to clear my throat. Loretta Mester said just this morning, we're hearing businesses say that prices and supply chain issues are going up and getting worse. They're not getting better. Then we had Mr. Bullard there right after say, it looks like we're seeing businesses willing to pass along prices to consumers, and consumers are willing to pay that. So we're seeing more risks to inflation. Both of the people that were talking this morning, people that were talking yesterday, all these different folks from the Fed were much more hawkish than how Jerome Powell opened up his discussion this morning. That's leading the market to go up because people were starting to price in that, oh, what if what they're saying is a representation of what Jerome Powell thinks? But Jerome Powell comes out instead and says, no, everybody calm down. Inflation measures are very noisy. And what we're going to do is we're going to look for patterns. And we believe that patterns in inflation right now show that we should continue to expect a deflationary trend and that most inflation is going to be temporary. Now, he said something really, really interesting that I had not thought of before. And he hasn't, at least in my experience, I have not seen anyone at the Fed talk about this before. This to me was mind-blowing. So I'm gonna use a little drawing pad here to break down this part because this was very interesting. He said that if we have high inflation and we try to respond with policy to push that inflation down, and we respond here where this green arrow is, but then inflation ends up being transitory and rotates down, our policy action actually has a lag. So rather than our policy action happening where this green arrow is, our policy action to slow down inflation might come late. And if the reasons we took policy action were high inflation, but then our policy action takes effect later when inflation is lower, then we could really hurt the market, that this would be hurting the market. This was really fascinating to me. This is something I've not heard them talk about before, but it makes a lot of sense. It's kind of like them saying, look, if inflation's like 5% right now, and then let's just go extreme, okay? Oh my gosh, inflation's 5%. Let's YOLO into raising interest rates to 2%. The impact of that interest rate might not come until over here, say 4 or 5 months later. And all of a sudden, if inflation's at 2% and now rates get jacked up, could that crash the economy, right? So this was a very interesting analogy Well, the analogy I made is the analogy. He said it. And I thought this was really interesting to suggest that, hey, like we just have to be patient, because if we act too soon and we don't have guaranteed sustained positive inflation, then we could react and then end up crashing the economy when the temporary factors go away. He gave one of my favorite examples, used car prices. We already see an inflection point in used car prices. We've seen used car prices go up like 7%, 10%, 7% over and over and over again. Last month, they only went up 1%. Used car prices don't go up forever. Now, if used car prices go up a ton and then they stay flat, inflation is zero. But if more cars start hitting the market and the demand for cars at expensive prices starts to wane, then we start seeing prices go down on used cars. Well, now it's kind of like you take your inflation report and you attach an anchor to it. And the anchor is used car prices. Because if used car prices start going down 5% a month or 7% or 10% a month, well, all of a sudden, kind of like what lumber did, you have a huge anchor on the CPI report. And every month, even if other things start going up, the anchor of used car prices could pull this down. And this is what Jerome Powell is expecting. He says, look, we've got clear progress to maximum employment, but we want to be very clear that even though we might taper this year, he did not say that we would taper on September 22nd, which is an expectation, by the way. Reason for that is we get our jobs report that comes out on the 3rd of September. We expect that to come in pretty darn good, especially since unemployment benefits expire that week. Of course, that is a measure from August. And then we get CPI data that comes out on the 14th. It sounds like Jerome Powell is expecting that CPI data that comes out on the 14th is actually going to be CPI data that helps tank potentially inflation a little bit. And that might give Jerome Powell reason on the 22nd to say, let's just wait on tapering a little bit. Maybe we'll start the taper around December. Doesn't have to be right away in September. So we're going to see that debate between him and other board members happening at that FOMC meeting starting on the 22nd. So Jerome Powell goes on to talk about how global deflationary forces are still present. And that really we're seeing inflation propped up right now by durables like washers and dryers and refrigerators and air conditions. And we are well above 2% right now, which is not good, but we think that those will wane. He also mentioned the outlook for the labor market has brightened considerably. The unemployment rate is down to 5.4%, but let's be real, 5.4% is still way too high, he said. Still too high. So obviously takes time to get this down, takes the support of Federal Reserve to get that employment rate down. Says that labor force participation is lagging, says this is normal after a recession. Does say that Delta provides a near-term risk, but the prospects are good for progress towards maximum employment. To me, it sounds like the Federal Reserve, honestly, they're kind of casting Delta aside. They're not too concerned about Delta. They're very, it seems like, hey, look, we've got vaccination happening. We're getting to maybe herd immunity. They don't seem devastatingly concerned about Delta. They barely spent time talking about it. And it really just seems like they don't care. Now, I shouldn't say they don't care about people getting sick or vaccinated, right? But in terms of their policy, I don't think Delta has a big weight, which is interesting, potentially for recovery stocks. But anyway, business and consumers reporting upward pressure on inflation. Inflation at these levels is a cause for concern, tempered by indications to suggest that these are temporary. So in other words, where we are right now with inflation is unacceptable, but we expect this to be temporary. Now, he said this forever. The crazy thing, though, is he's being consistent. He's being consistent, more dovish than expected. He mentions that we've got little evidence of a wage price spiral. This is when wages go up, leading to prices going up. Now that prices are up and the cost of doing business is higher, we potentially see inflation, prices going up even more. And when prices go up even more, then that might create an opportunity for wages to go up again, which increases the cost of doing business. So prices go up again, right? That sort of spiral up. He says he actually does not see happening. No evidence of that happening. He also believes that globalization, technology, and greater deflationary forces are still present. The tightening too early, I thought, was such an incredible talk. But then most importantly, when he talked about interest rates, he says that, look, we might be talking about tapering, but no, this really has nothing to do with when we expect to raise interest rates, that we don't really There's no link between when we taper and when we raise rates, was his phraseology, and that it's important to know that raising rates is much more aggressive and really designed for a much stronger market than where we are now. So really, the market is cheering this. The market is cheering this over the thoughts of, hey, great. Doesn't sound like rates are going to go up anytime soon. Doesn't sound like we've got long run concerns with inflation. What's crazy about this is you actually have ADA skyrocketing on this and moved another 6%. So you've got crypto moving to the upside after this discussion. This discussion was a perfect catalyst for crypto. Look at this. You've got Bitcoin shot up off of our support line here. This line is such a strong line right here. But anyway, we shot straight off of this. Jerome Powell started talking at 7, which was right here. And you could really see this is all the J Powell line right here. So we see crypto getting pushed up. On the minute chart, we see, here's, for example, EXPI. Not a clear correlation here. Let's go to SPY. You do see a clear move in the SPY. Look at that. This is as soon as J Powell starts talking. A little softening there, but you got a very, very evident move in the markets to the upside after Jerome Powell's discussion here at the Jackson Hole Symposium. So very good. Very, very good. This is very counter to a lot of the other more hawkish members at the Federal Reserve. This suggests that Jerome Powell is staying the course, and that even though we might taper this year, it's unlikely that we'll raise rates anytime soon. And we don't want to act too soon because we don't want inflation to inflect down and then our policy actions to have their results potentially crashing the market. So it's better to stay supportive right now until at least we figure out if this inflation is indeed temporary or not, which, remember, mark your calendar, September 3rd for the jobs report, expecting that to come in between 8 to 900,000. If it comes in higher or hotter, obviously that could signal a taper sooner. We have the 14th for a CPI data release, 5:30 in the morning Pacific time, and then the FOMC meeting on the 22nd. So there you have it, folks. Thank you very much for watching. Make sure to get your free stock with Public. Go to metkevin.com/public. Make sure to check out the programs on building your wealth. I did a small sell transaction this morning. I expect to do some more buy transactions either today or next week. I want to get some more of the cash that I have into the market, into some leftover opportunities that I potentially see, especially going into the September, October. Really excited for this. So if you want to make sure you get all of those alerts, join the Stocks and Psychology Money Group. Consider checking out the other programs as well that you can bundle up for. Use that 40% off coupon code Jack's Birthday. And folks, see you in the next one.